Today, we are going to learn about the 4 advantages of small investors your fund managers don't want you to know. If you are new here and want more tips on wealth building and investing, start now by subscribing and click the bell icon. Now, let's get started. Number 1. Nimble. Small investors are nimble to enter or exit the stock market. As a small investor, you will most likely be buying just a few hundred shares. To you, this may sound like a lot of money, or even your whole net worth. But to the stock market as a whole, the amount you just brought might be just peanuts. Even if you sell everything, the price of the stock will not even change a lot. Having a small position in the stock can be a huge advantage over the big boys, such as the rich fund managers. These fund managers always have tens of thousands of shares invested in each of the stocks. So what's your advantage? Having a small position means that you can buy or sell as and when you want. Even when there is a panic sell-off in the stock market, it will be fairly easy for you to sell everything you own with just a click of your mouse. As a small investor, buying in and out of the stock can be fairly simple. On the other hand, the big fund managers are buying millions of dollars of stock. Each trade can take days, or even weeks for them to finish. By the time they finish buying, the price of the stock may have already risen significantly. When it is time for them to sell, these fund managers will take a long time to sell their position. When they sell, they will move the price of the stock down. And by the time they finish selling, they will pocket much lesser profit than they have wanted earlier. Our conclusion? Small investor win. Number 2. More options. Yes. In fact, you have more options to invest than Warren Buffett or any of the big fund managers. This is because you don't need to make hundreds of millions in profit to make an impact on your investment portfolio. As a small investor, pocketing $100,000 return will probably make us thrill. Choosing to invest in small companies or large companies don't really matter. What we really want is just to invest in something that gives us a good return on the investment. Although a great company that has the potential of giving us a 100% return is hard to find. Those with a potential upside of 100% return, or even 10 times your return, are usually found in small caps. When we found such a great company, aka unicorns, we can simply lock in our investment in just a click of the mouse. But for big fund managers, who are handling billions of dollars every day, earning a few $100,000 won't help them in their investment portfolios. Because they need hundreds of millions of profit to even see some significant change to their overall returns. For every investment, they have to put in tens of hours on research to see if it is a good investment. The time can be better spent on investment that truly makes an impact on their investment portfolio. This means, even if they know an amazing small company that can potentially grow 10 times the price and gets 10 times the return, there is no point for a fund manager to invest in it. Simply because companies that are worth just a few $100 million market capitalizations are just too small for them. Just for context, in the US market, all companies under $1 billion are considered small companies. Let's take an example. Google Incorporated was once a small company many years back. If you have invested $1,000 in GOOGL in the year 2004, when it is still considered as a small company, you will be holding more than $30,000 today, for a total return of over 3,000%. That is a compound annual ROI of 25.58%. And that's just mind-blowing. Our conclusion? Small investor win. Number 3. Control. As a small investor, you can invest as and when you want to invest without hundreds of people breathing down your neck, telling you what you should do next. If the market is overvalued and shows signs of a market crash, you can sell those stocks which you think are overvalued. And probably wait for the next opportunity to enter the market. This level of control may even give you the opportunity to profit from the market crash, while the fund managers are busy selling their portfolio. Big fund managers, on the other hand, don't have that much control as you do. As a fund manager, they are expected to keep on investing. They have to be kept invested in the market even if they know the market is overvalued. If a fund manager stops buying stocks and keeps the funds in cash, simply because the market is overvalued, the investors, who have given the money to the fund manager, will withdraw their money and give it to another fund manager. Most investors are impatient. They want to see their money doing something, even when the best decision for investing is to do nothing and wait for an opportunity. Thus, it is in the best interest of the fund managers to invest all the funds in some stocks, even if they know the market is overvalued. For investing, you can do 3 actions. 1. Buy a stock. 2. Sell a stock. 3. Do nothing. Charlie Munger, Vice President of Berkshire Hathaway Incorporated and lifelong friend of Warren Buffett, said these words during one of his interviews. You don't make money when you buy, and you don't make money when you sell. You make money when you wait. Fund managers can't wait, but small investors like you can. Our conclusion? Small investor win. Number 4. Risk. Do you want to choose your own level of risk, or do you want someone else to choose for you? As a small investor, you can choose to invest in some riskier stocks, but with the potential of an extremely high return on the investment. Or, if you are the conservative type, you can invest in ETFs or blue chip stocks. These have a much lower risk. The choice is always in your hand. Fund managers don't have this luxury of choice. They need to perform in line with some of the benchmark investment, even if it means losing money. In other words, they have to give up the potential opportunity of getting a massive return, and pursue a proven path for investing in average return. The choices that fund managers have when investing is limited. Even when they have the ability, knowledge, and resources available to make amazing returns, they are not able to buy that investment, simply because they have to follow the rules set by their investment firm. Our conclusion? Small investor win. Before we go to the bonus content, click like and subscribe, because more great content like this is on the way. We're curious to know, which of these surprise you? Come and let us know in the comments below. And here is your bonus. Inefficiencies. Heard of the efficient market theory? Far from what your professor tells you in school, the market is not always efficient. And Warren Buffett, with a net worth of over $76 billion, can attest to that. Occasionally, inefficiencies are created by fund managers. This helps small investors like us to make a nice fat profit. For example, an opportunity can occur when a company splits, or is spun off into specialized companies. Big fund managers may sell to avoid smaller companies. This created a chance for small investors like you to buy at a reduced price. Or when a stock is removed from a popular index such as S&P 500, they will sell it, even if the outlook of the stock is great. As a small investor, you can benefit if you believe the stock is a good buy. If you have learned something valuable from here, click like and subscribe. This will be your first step into the world of investing. Our next video will show you more secrets about investing. Let's go.